In today's episode of the MSA Rental Market Update, we are looking at the Albuquerque rental market for conventional multifamily properties. As you can see, the metro statistical area is being outlined by CoStar on the map here, and you can see that it kind of circumvents around the capital city of Santa Fe in New Mexico. To get an idea where this is located, we have Tucson, Arizona, and Phoenix, Arizona over here. Here is Las Vegas. Salt Lake City's up here to the north. Here is Denver, Wichita, Kansas, Oklahoma City, Dallas, Fort Worth, Austin, and San Antonio. And tucked away over here is El Paso, Texas. So, what filters are we looking at for this data set? As usual, we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable, so we are only looking at conventional apartments. If we go to location, you can see we are in market, metro statistical area, Albuquerque, New Mexico. So let's go take a look at the analytics and see what the analytics tell us for all three asset classes combined, and then we will look at each individual asset class. So here is our supply side snapshot for the Albuquerque metro statistical area. There are 1,433 conventional apartments in this market, totaling 54,995 units. There is still 3,458 units under construction, and in the last 12 months, 934 more units went vacant than rented. And in the previous 12 months, only 366 more units rented than went vacant. And we can see that in our vacancy rate, where we were at 4.7% a year ago, and it is at 6.4% today. We are seeing a year-over-year rent increase in the market. We'll see what it looks like quarter after quarter. As usual, we are not looking at the capital markets. We are only looking at the space market. If we scroll down and take a look at our long-term occupancy average, we can see that this market likes to be around 93.5, and it is sitting at 93.6. So it is literally sitting right on that long-term occupancy average. So let's go take a look and see what all three asset classes tell us first. And then at the end of the video, we will come down and we will see where we will place the Albuquerque metro statistical area on the market cycle chart. From what we see so far, it looks like it's probably going to be right here on this point on the long-term occupancy average between oversupply and recession. But we don't know until we look at the data. So, that said, let's go take a look at the data for all three asset classes combined. So here is the data analytics for all three asset classes. We do not look at asking rent. We don't care what the owners are asking. We only care what they are collecting. As you can see, in the first quarter of 2022, they were getting $1,091 a month, went up to $1,140, up to $1,155, and then we had the break between the third and fourth quarter down to $1,145. If we scroll over and take a look at deliveries and absorption, we can see there were virtually no deliveries in the marketplace. There are still properties under construction, and we are seeing negative absorption across all three asset classes. So where we started at 95.3% in the first quarter, we ended at 94% in the fourth quarter. So, we were just getting under that 94% mark, getting towards that long-term occupancy average, which I believe is why it took a little bit of time for those rents to break. But they are now starting to break, and it doesn't look like this trend is going to stop, where more units are going vacant than are being rented each year. As these units start to come online, this could tell a pretty sad story for Albuquerque. But we'll have to see, because as the rents start to trend downward, we'll see what these deliver at and see if they can't absorb. So this is the overall look at all three asset classes. Let's go see what the Class A space looks like and see what story we can glean from it. Here is our Class A rent analytic data. There are 23 properties totaling 4,449 units. Looking at effective rent, it was at $1,534 in the first quarter, went up to $1,640, up to $1,649. And then as with all three asset classes combined, it broke between the third and fourth quarter, went down to $1,626. Looking at deliveries, there were no deliveries. We still have 1,382 units under construction. It did absorb a little bit in the first and second quarter, causing that occupancy to go up to 96%. But then it has trended down to below that 95% mark because we are sitting at negative absorption of 19 and 33 in the third and fourth quarter, causing that fourth quarter rent to trend downward. As these units deliver, as with all three asset classes, it's going to be interesting to see if the Class A's can absorb those units at these rental rates, or how far the rates have to come down before they can start to absorb. So that's Class A's. Let's go take a look and see what story the B's are telling us. Here is our Class B rent analytic data. We have 328 properties totaling 28,903 units. Looking at effective rent, started first quarter 2022 at $1,149, up to $1,201, up to $1,225, and as with the Class A's, the break happened between the third and fourth quarter and down to $1,209. If we scroll over and look at deliveries and absorption, we had no deliveries. We still have 1,864 units under construction. And as with all three asset classes combined, it does not look like the B class is doing very well. These residents have basically said, we can no longer afford these rents. And so they are either moving to the C's. We'll see what absorption looks like in the C's. Or they are doubling and tripling up because we had no absorption in the A's, and the B is showing even worse absorption than that. So far, the B's do look to be the weakest of all three asset classes. We have not looked at the C class yet, but this market is definitely lacking in demand from what we've seen so far, and with all these units still under construction, albeit fairly moderate, only 3,600 something overall between the A's and B's. Not too terribly bad, which might be a good thing. Now, if this is true, and another 190 units went under construction between the fourth quarter and January, if that's actually true, what in the world were those developers thinking, seeing this negative demand occur? So, interesting tale there, but we're not looking at January or first quarter 2023 data, so we're going to discount it right now. So let's go take a look and see what story the Class C market is telling us. So here is our Class C rent analytic data. There are 1,002 properties totaling 21,513 units. Looking at effective rent, it was at $851 in the first quarter, up to $875 in the second quarter, stabilized at $877 to the third, and then slightly up to $881 in the fourth. So, little interesting that we didn't have that break. Let's see if absorption tells the same story as before, and it does. And we're down to about, getting close down to about 93% occupancy. Not quite there yet. If you look at that January data, it says we are, but we are not looking at that. We're discounting it right now. So we're calling it 93.7 right now. And we're not really seeing a break in those rents yet. A little surprising. I think moving forward as this negative demand continues, that we will see that as well. So they're leaving the A's. Are they going to the B's? No. The B's were all negative absorption in all four quarters. So are they going to the C's? Well, as we could see here, C's are also negative absorption in 3 of the 4 quarters, really flat in the first quarter. So they're not going to the C's. So what story is that telling us? That tells us that the people in this market are either leaving the market completely and moving somewhere else, which probably isn't the case, or they are roommating up, or what's known as doubling, which is probably the case. So we can definitely see that demand has waned in this market, and absorption is going the wrong direction. So what does it look like on the market cycle chart? So if we look at Albuquerque, New Mexico's metro statistical area, we know that we have units under construction and that we've been delivering, albeit we didn't deliver any this year. So there are under construction. We know we're on this long-term occupancy average. That puts us over here in the oversupply phase. And the fact that in 2 of the 3 asset classes, rents are going backwards from the third quarter to the fourth quarter. In 1 asset class, the C's, we had a slight increase of $4. I believe that we can very comfortably put this market right here on the recession line, in between oversupply and recession, right on the long-term occupancy line, and say that in the next quarter or 2, we're going to watch it move down to the next spot. I do not believe we'll see it back up. I do believe this one's going to continue to go down because we're not seeing any slowdown in that negative absorption at all. So the Albuquerque metro statistical area rental market is sitting right here in between oversupply and recession on the long-term occupancy average. So that does it for Albuquerque. Stay tuned tomorrow as we head north and go up to Chicago, Illinois. I will see you guys tomorrow.